Hey everyone, do you want to make some comments on the whole Brexit exit thing? Um, because a few of you had sent me emails and or a couple texts or something. Thankfully, a lot of you weren't too worried about it. Well, could be a good or a bad thing. First off, UK voted to leave the eurozone. At least they had a referendum that 51 plus percent of the people wanted to leave the eurozone. If they were to do this, they still have to go to Parliament and they have to follow legal procedures. Then there's a 2 year process to leaving. So nothing instant happened. So that's the first off. Second thing, it caused a lot of strife in European markets, and a little bit spilled over to U.S. markets. So we had, U.S. stocks dropped. Some of them dropped 3, 4, 5%. In the span of a day, day and a half. And of course, like every other dip, it was so bought so aggressively. We'll discuss that in a minute, but um, what made me worry about it, and maybe no one calling me, was now finally people are so numb to all of this that they don't even bother calling and asking what's going on anymore. Even though this um, didn't really apply to, anyway, it's, to our clients, we do have a pretty good sized bond position in gold, and both of them have risen through this. They've actually been rising since the beginning of the year for the most part, and um, so the trends just kind of continued because the market's been expecting turmoil, the idea that the Fed is not going to raise rates and all this stuff. They're expecting this stuff, so bonds have just been going up. Anything that pays a yield has gone up, and gold because the central banks are just trashing their currencies. Japanese one of the Japanese central bankers came out the other day saying they'll do what they have to do, which was amazing considering they've already done so much. I don't know what else they plan on doing. They're buying stocks in Japan. The central bank is buying stocks. It's so ridiculous to somebody who's been involved in finance for like 20 plus years and studied in school. It's so ridiculous. I can't even explain to my clients how ridiculous it is. I'm not even going to bother, but it's unfathomable to me what they are doing. The central bank is buying stocks. You see this stuff in like crappy third world countries, Mickey Mouse type countries. You don't see this in established places. And now in Europe, they're buying corporate bonds. Really, talk about like treating the symptom, not the problem. Just ridiculous. Anyway, back to the yield thing. People are buying anything with a yield. All right, I'm just kind of checking the market while I'm over here. People are buying anything with a yield, and therefore, if U.S. stocks, which have some kind of dividend, drop in value 3 or 4%, they're getting bought aggressively. Anything with a dividend, and it's been working. It's been working for a long time. It's still working because as we go to 0% interest rates, think about this. There are many institutions that have to buy. They have to buy investments to put their so health insurance companies. I just read that Blue Cross, lost it was something like 50 or something $1 million. Hey everyone, Chris Grandy out here on the pond next to Belmont High School, across the street from my office. Great place to be outside. Rose bushes, beautiful. Anyway, just continuing on, I decided to take that video outside. So we started inside, coming outside. So following up, I want to finish my thoughts on the yield. Investors are looking for any kind of yield. If a company like Blue Cross loses $51 million in a quarter, based on various needs, there are companies like Blue Cross, large insurers. There are, especially them, pension funds, things like that. These places, they project out what they need to earn in their investments in order to meet their future obligations. So they do like pension type of accounting, or future value, present value accounting. They try to project out over so many years what they're going to need for resources to handle their bills or their pension obligations, and they end up assuming a rate of return they're going to get. And they try to assume a rate of return that's close to what they think they'll get. But if you now start rolling in, now that we've had, say, 7 years of 0% interest rates, if they are, if all their old bonds and things are maturing and they're reinvesting into new bonds that are paying 1.5% instead of the 4 to 5 or 6 that they were making years ago, this makes it very difficult for pensions, for insurance companies, etc., to hit their target rate of return. It's hard to hit a rate of return of 7.5% when your bonds are earning like 1. because you got to figure, okay, well, if I want to have a balanced portfolio, and most of them, especially insurers and stuff, are required to have triple, oftentimes, investment grade portfolio, which means they're rated by rating agencies as investment grade, which, for those of you that know about this stuff a little bit, triple B or better rated with Standard & Poor's, meaning triple B, A, double A, or triple A rated bonds. So these type of bonds too are the ones that are paying the lowest interest rates because they're the safest. So if they have to have most of their assets in these type of investments, and so they're only getting 1%, let's think of their allocation. Let's say they want to have 70% of their assets in bonds, and 10% in real estate, 10% in stocks, and 10% in, say, alternatives. If 70% of their portfolio is earning 1%, how are they going to hit a target rate of return of 7 or 8%? Not going to happen. So we have some issues here where this could really blow up on us. So I think what's happening is, and if those of you that follow me on Twitter will see this, I think what's happening is that professional funds and things are using stocks as a replacement for bonds. And I've tweeted this many times, stocks are the new bonds. If you can only get 1% in a bond, investors are going out now and they're buying Intel or Cisco or Microsoft or any of these companies, GE, Verizon, that pay a 4% dividend, and they're I'm guessing, this is a guess, that investors are replacing their bonds with these stocks. Of course, there's inherently much more risk in that, but in this market where every dip has been bought and every correction is seen as a buying opportunity, and then every time the market falls 3%, the heavy breathers come and start buying stuff up. It just tells you people are really desperate for this yield. I don't think this is going to end very well, but I believe that this drive for yield is causing huge misallocations again in the financial markets. And I don't know where this is going to play out, but it's going to get kind of messy. And so those of you know that I like to take a trading approach with clients' assets a lot of the time, and that's, that if things really turn sour, we're not going to just buy and hold and watch things, we've done this before in 2007 and 8, we're not going to let stuff just fall down the sewer. So just that's something to think about. So what's going on in the current market, I would summarize it as just this relentless drive for any kind of income return. And right now the people are looking at leveraged munis, municipal bonds, and stocks, dividend paying stocks, and that's where all the action is. Utility stocks at an all-time, the index at an all-time high. If you for those of you that want to look it up, XLU, the Utilities Index Exchange Traded Fund, all-time high. People want those dividends. They don't really care how they get those dividends. The company might not be growing, doesn't matter. These dividend paying stocks are like bonds to them, and that's really what's happening. So that's just my kind of outline of what's going on in the financial markets. Hope that's helpful to you, just to get some background as to kind of current psychology and what I feel is the way things are happening. Thanks again. We'll have more videos and obviously more stuff in the next section about different things.